Welcome to the Vanguard Watch. On one single Monday morning, investors all around the globe suddenly hit the panic button on the United States. It kicked off what traders call a sell America market, something that's pretty rare. It has some very real consequences for your money, so we're going to break down exactly what happened, why it's such a big deal, and how this high-stakes showdown in Washington could change the price of everything from your mortgage to your next trip abroad. So it all started with this one piece of news that dropped early on a Monday morning, which shook the confidence of the global markets that they had in the US economy. Before knowing about the news, let's first listen about its consequences. The US dollar, the currency that basically powers the world, it started to fall. The interest rate on US government debt, the Treasury yield, it shot through the roof. At the exact same time, investors were rushing into old school safe havens, sending the price of gold and silver way up. Here's the thing. When everything lines up like this, the signal becomes impossible to miss. Money is flowing out of American investments fast. What sparked such a sudden shift? Turns out someone took aim at an institution many thought untouchable, the US Federal Reserve. The Department of Justice, the top law enforcement agency in the country, was hitting the Fed with subpoenas for a criminal investigation. I mean, an action like this, going after the central bank, it's completely unheard of in modern American history. And you better believe that it set off alarm bells on trading floors from New York all the way to Tokyo. And this is where things get really interesting, because you basically have two completely different stories. Officially, the Department of Justice is saying, oh, this is just about some testimony over renovating a few old buildings. But the Federal Reserve Chair, Jerome Powell, he came out swinging, calling that a total smokescreen. He claimed the real motive was to pressure the Fed because the president wasn't happy with their interest rate decisions. And that accusation right there, that gets us to the absolute heart of this whole crisis. This isn't really about buildings at all. This is a fundamental battle over whether the Federal Reserve gets to be independent. And listen to how Jerome Powell put it himself. He's pretty much saying, look, this is a fight for the soul of the central bank. Is it going to be run by experts looking at economic data to keep things stable? Or is it going to be run by politicians trying to score short-term political points? This brings us to this really important idea, central bank independence. It sounds kind of academic, but for decades it's been a bedrock of the US economy. The idea is simple. You want a wall between politicians and the people controlling the nation's money supply. You really don't want a political leader juicing the economy right before an election, only for it to come crashing down later. History is littered with examples of that going horribly, horribly wrong. And look, this isn't some fringe concept. We're talking former Fed chairs appointed by both Republican and Democratic presidents. People like Bernanke, Yellen, Alan Greenspan, they've all said this independence is absolutely vital. It's how the Fed does its job, keeping prices from going crazy, trying to get to full employment, and just keeping everyone confident in the system. Okay, so you're probably thinking, a big fight in DC over some economic principle? Why should I care? Well, because this stuff, as abstract as it sounds, actually hits you right in the wallet. Let's break down how. It all works like a chain reaction, right? Step 1. Global investors see what's happening and get nervous about political meddling, so they start selling US government bonds. Step 2, it's just basic supply and demand. When tons of people sell something, its price falls. But with bonds, there's a weird quirk. When the price goes down, the interest rate goes up. And here's the main thing. Step 3, your mortgage rate tracks that government bond yield almost perfectly. And the numbers really tell the tale here. The 10-year Treasury yield, in simpler terms it is called as interest rate on government debt, which is the big one for mortgages, just shot past 4.2%. The 30-year jumped to over 4.8%. These were the highest we've seen since last September. A spike like this just means that the cost to borrow money for a house, for a car, for a business, it's all about to go up. Oh, and there's another hit to your budget. Remember how the US dollar was falling? Well, that directly weakens your spending power. All those things we import, from electronics to cars, they get more expensive. That vacation you were planning to Europe or Asia, it just got more expensive too, because your dollars literally buy less than they did before. Now, for the people investing the big money, this investigation into the Fed didn't just happen in a vacuum. That was it, the tipping point. The government's been so unpredictable lately that investors were already nervous. This latest move just pushed them over the edge. I mean, just look at the week leading up to this. There was a surprise ban on big institutions buying up homes, a total 180 on defense company policy, a demand to cap all credit card interest rates at 10%, and even a public threat against a huge company like ExxonMobil. For markets that absolutely need predictability, this kind of policy whiplash is terrifying. And you can see the immediate fallout from just one of those ideas. The second the president called for that 10% cap on credit cards, look what happened. The stocks of the companies that issue them just plunged. Capital One dropped over 7%, American Express and Citi both fell 4%. The market was reacting instantly to the threat. So when you put all of this together, the unpredictable policies, and now a direct challenge to the Fed, it starts to raise some really serious questions about the stability of the US economy going forward. And here's the long-term danger that has economists so worried. If the public and the market start to believe the Fed is no longer independent, it loses its most powerful weapon, its credibility. And a Fed that nobody trusts is going to find it much, much harder to control inflation, which, is its main job. To really get what's at risk here, think about this. Less than a year ago, the credit rating agency Moody's literally pointed to the Fed's independence as a core reason for America's economic strength. It was a pillar of stability. Today, as the markets are clearly telling us, that pillar is shaking. So it all leaves us with this one massive fundamental question. This whole thing isn't just about one bad day for the markets. It's about a core principle of how we run our economy. And as this situation plays out, the answer we find to where we draw that line between politics and economics is going to have consequences for all of us. Now let's look into the entire battle that's shaking up the entire US economy in a detailed manner. It's a fight over power, over precedent, and really over the independence of the one institution that sets the interest rates for pretty much everything from your mortgage to your car loan. And things really kicked off with this. I mean, talk about a bombshell. The head of the nation's central bank, Jerome Powell, comes out and says he's under a criminal investigation by the very administration he's supposed to be working with. That is just not something you see, ever. So the official story is that this investigation is about some renovations on a Federal Reserve building. But, a lot of people are looking at this and thinking, come on. They suspect this is just a cover story, a flimsy excuse, a pretext to find a reason, any reason, to force Powell out of his job because he isn't lowering interest rates the way the president wants. To really get why this is such a massive deal, we've got to rewind the clock a bit. Why is the Federal Reserve designed to be independent from political pressure in the first place? Well, it all goes back to a painful lesson from the 1970s. Think about the Fed's job. It's this incredibly delicate balancing act, right? They're trying to keep inflation low so your money is worth something, but also keep the economy growing so people have jobs. It's run by economic experts, technocrats, who are supposed to be shielded from day-to-day political drama so they can make the best long-term decision. And here's the classic cautionary tale. Back in the 70s, President Nixon leaned hard on the Fed chairman to slash interest rates and juice the economy right before his re-election campaign. Look, politically, it was a masterstroke. He absolutely crushed the election. But the fallout was a nightmare. The country spent years dealing with the mess of stagflation. It's that brutal combo where everything gets more expensive, but the economy is completely stuck. It was a rough time for everyone. So because of that whole economic nightmare, this really important legal safeguard was put in place. Fed governors can only be fired for cause. We're talking serious misconduct, not just because a president doesn't like their interest rate policy. Think of it as a firewall, built to keep short-term political wins from burning down the economy for the rest of us. And look, this isn't just ancient history. We're actually seeing a similar drama unfold right now with Fed Governor Lisa Cook, and a lot of people see her case as a legal test run for what could happen to Jerome Powell. So the strategy seems to be this. The administration accused Cook of making contradictory statements on mortgage documents, claiming two different properties as their main home. But then, when you actually look at the paperwork, it seems pretty clear. One property was explicitly listed as a vacation home. The lender knew it and agreed to it in writing. So the allegation just doesn't seem to hold water. And in court, the arguments are, well, they're pretty bold. The administration is essentially saying, our decision to fire someone, you can't even question it. They're arguing that federal officials don't really have a right to due process, and that waiting just a few days is all the process they need. They're basically asking the court to just take their word for it, no questions asked. And all of this lands right on the doorstep of the Supreme Court, which now has to sort out a puzzle that, honestly, it kind of created for itself. Now, for the most part, the court's conservative majority likes this idea called the unitary executive theory. It's a fancy way of saying the president is the boss and should be able to fire people who work for him to make sure his agenda gets done. Pretty straightforward. But then, in a move that surprised a lot of people, the Supreme Court basically said, yeah, but the Fed is different. In a recent case, they carved out a special exception to that whole theory, declaring that the rule doesn't apply to the Federal Reserve. They said the Fed is unique. And here's the court's official reasoning, which, let's be honest, has been called word salad by a lot of legal experts. It's all pretty blurry, honestly. It's left people wondering why the Fed gets this special treatment in the first place. Which really leads us to the big question. What is the point of having this special protection for the Fed if it can be so easily sidestepped? Think about it. What's the point of a rule if a president can just invent a reason to fire someone and no one is allowed to check if they're lying? This isn't just some boring legal technicality, though. This is a massive showdown that hits you directly in the wallet and could shake the entire economy. See, what happens in Lisa Cook's case is a huge deal because it's seen as the test run. It sets the precedent. If the administration can successfully use a pretext to fire her, then they can almost certainly use that same playbook on Fed Chair Jerome Powell. And I really want to drive this point home. This fight has a direct line to your finances. If the Fed loses its independence, decisions about interest rates could be based on what's good for a politician's re-election campaign, not what's good for the long-term health of the economy. And that affects everything: jobs, prices, how much you pay to borrow money. So the first big question for the Supreme Court is this: can a president just invent a reason to fire a Fed governor? And does everyone just have to take their word for it, even if the reason looks completely made up? And the second question is really about the court itself. Are they going to stand by their own ruling, this special exception they just created for the Fed? Or are they going to let it become totally meaningless by allowing it to be bypassed with a claim that nobody can check? It really forces us to ask, who should be in the driver's seat of the U.S. economy? Is it politicians chasing quick votes, or independent pros focused on keeping things stable? There's no easy answer, but whatever happens next is going to set the tone for our financial future for a generation.